Today's earnings batch split the AI trade into two entirely different realities. We had a hardware giant secretly arranging billions in private credit just so customers could afford their products, while a pure software company completely collapsed and fired a huge chunk of its staff.
Right. Looking at the June 3rd window, the divergence between companies like Broadcom and C3.ai is frankly fascinating to watch play out. It is the physical infrastructure boom pulling rapidly away from the application bust.
Yes, and let's start with Broadcom because they are hitting a massive physical bottleneck. They intentionally bloated their component inventory to hoard parts defensively. And the real tell, the concrete action here, they helped set up a $35 billion private credit platform with Blackstone and Apollo.
That is probably the most telling detail of the day, Susie. Hock Tan, Broadcom's CEO, tells Wall Street it is all chips and no racks. But the actual cost to deploy these AI data centers has totally breached standard IT budgets.
Which means the physical reality is dragging them into shadow banking. I mean, you do not bring in Apollo unless your enterprise clients are genuinely struggling to finance the buildout.
Precisely. The demand is real, but the capital intensity is just off the charts. And that contrasts so sharply with the software side, where capital isn't the physical issue, but demand is essentially stalling out. Look at what happened with C3.ai today.
Wow, yeah, their revenue plummeted, and they explicitly walked away from modern pay-as-you-go consumption pricing. They are fully retreating back to hunting for giant, locked-in legacy contracts just to survive.
I think the human operational side is even stranger than the pricing pivot. To function after firing 35% of their workforce, management admitted they are aggressively deploying competitor AI bots to run their coding and marketing.
That has to be the darkest irony of this whole reporting window. An AI company firing humans because they cannot sell their own software, and then using outside bots to keep their own operations afloat.
It really proves enterprises will pay for the physical network, but they are not scaling up software licenses yet, which makes the reporting choices across the broader software space look a bit stretched. Even CrowdStrike, which posted very strong growth, is playing with timelines.
Yeah, that was an interesting adjustment. They stretched the amortization period for their sales commissions out from 4 years to 5 years. That one little accounting change mathematically adds roughly $90 million to their forward operating income.
Right, so headline margins expand, but the underlying cash efficiency is slightly less clean than the paper metric suggests. When hardware is eating all the enterprise budget, software companies are forced to find margin elsewhere.
And that is exactly what makes the coming quarters so fragile, especially since C3.ai completely deleted the remaining performance obligations from their reports today, effectively pulling their visibility metrics offline.
That is the ultimate metric to watch. Without that backlog data, the market is flying totally blind on their turnaround.
Which is exactly why the full deep dive episodes sitting in the feed are so valuable today, because they break down the exact capital mechanics at Broadcom and that desperate pricing pivot in the software market. Until tomorrow, thanks for joining us.